As our founding father, Ben Franklin, so eloquently put it, I got 99 problems, but wait, no, that wasn't it. In this world, nothing is certain except death and taxes. Though I'd argue he's only partly correct about the latter. In this video, I'm going to cover tax brackets, how they work, and although it may seem that taxes are something you have no control over, I'll explain how understanding taxes can help you make smarter decisions that will help you save and make money. I'll even explain how it's possible to pay 0% taxes on some investments. Now I get it. Taxes aren't exactly the most popular topic. No one gets excited to see how much money is taken out of each paycheck.
Enough from the clown!
Let's not blow this out of proportion.
You think you could steal from us and just walk away?
Yeah.
But in any case, learning this stuff is crucial because ultimately, if you're gonna get screwed, you might as well try and get screwed over slightly less. First things first, what exactly are tax brackets? Simply put, they're income ranges that are taxed at different rates. The US has a progressive tax system, which means the more money you make, the higher percentage of your income you'll pay in taxes. But the good news is, you're not suddenly going to jump to a higher tax rate on all your income when you cross into a new bracket. That's where marginal tax rates come in. You only pay the higher tax rate on the portion of your income that falls within that specific bracket. As an example, if your filing status is single and your taxable income is $60,000, using 2024 numbers, you're in the 22% tax bracket, but you're not paying 22% on all $60,000. For the first chunk of your income, from $0 to $11,600, you'll pay 10%. From $11,601 to $47,150, you'll pay 12%. And from $47,151 to $60,000, you'll be taxed at the 22% rate. As your income increases, those higher portions of your income will continue to get taxed at progressively larger percentages, ultimately capping out at a 37% federal tax bracket. This should clear up a common misconception that moving to a higher tax bracket can reduce your overall income. People have actually avoided promotions and raises because they didn't want to end up in a higher tax bracket. Don't be this person. You're only paying the higher rate on a portion of your income, so you still end up with more money overall. Since your marginal tax rate doesn't exactly represent the true rate at which you're paying taxes, it's useful to compute your effective tax rate, which is the actual percentage of your total income that you pay in taxes. This can simply be calculated by dividing the total amount you paid in taxes by your taxable income. And it's always lower than your marginal tax rate, given that it takes into account portions of your income being taxed at a lower tax bracket. If, for nothing else, it's nice to be reminded you're not paying quite as much in taxes as your tax bracket would have you believe. So, why does all this matter? Well, aside from realizing that more often than not, you pay a significantly higher effective tax rate than a trillion-dollar company, understanding your tax bracket can help you make informed decisions about your finances and take you to that next investing level. Because listen, folks, this is the big leagues now. We're not just throwing money around into random investments and hoping for the best. No. This is about harnessing the very essence of a tax-avoiding billionaire to maximize your investment returns. So where can we start? The most common benefit will be how people manage their retirement contributions. If you have a retirement account, whether it's a 401k, 403b, TSP, or IRA, you'll need to determine whether you want that to be a traditional or a Roth account. As you know, traditional and Roth accounts treat taxes very differently. With a traditional account, you defer taxes until retirement, whereas with a Roth, you pay taxes now and never again. If you're unfamiliar with the differences between a traditional and a Roth account, check out some of my other videos explaining this topic. But the bottom line is, your tax bracket can have a major impact on how effectively you use your retirement accounts to grow wealth. Misunderstanding and choosing the wrong account type could end up costing you tens or even hundreds of thousands of dollars in retirement.
He chose poorly.
The next major area you can better control is your budgeting. The vast majority of people have no idea how much they should be taxed, or how much they've already paid via their tax withholdings, and as such, have no idea what to expect come filing season. How many times have you filed your taxes expecting a refund only to get hit with a major tax bill you weren't expecting. Not only is that a huge slap in the face, but if you were anticipating using your tax refund to pay off some bills or a large expense, this kind of surprise can be a real setback, especially if you don't have the savings and you're forced to take on credit card debt to cover it, which will lead you into a downward spiral of inevitable self-destruction. Well, maybe not that extreme, but only if you manage your debt quickly. So how can you prevent this? Well, although there are a few more things that go into your taxes than just your income, as we showed in our simplified example earlier, there are free online tools such as this tax calculator, which allows you to input all your sources of income from your job, any investment income, and can account for various tax credits and deductions. Playing around with something like this can be really helpful to get an accurate estimate of your taxes, so you can get a better idea whether your current tax withholdings are aligned with what your expected tax bill will be at the end of the year, and thereby predict whether to expect a refund or a tax bill, and by how much. Ultimately, so you can manage your spending and not get blasted in the face with an unexpected tax bill at the end of the year. I'll post a link to this calculator in the description below. Now, let's talk about how your tax bracket can influence your investment choices. There are various types of investments, and the returns are treated differently by the IRS. Knowing this can help you maximize your returns and avoid getting screwed over by Uncle Sam. You don't need another uncle screwing you. In general, investments will be either taxed as ordinary income, meaning it's added to your income and taxed at your regular tax bracket rate, or they will have a more favorable tax rate. Let's highlight a few key points. Some investments, like stocks, provide returns through appreciation. You buy a stock, it goes up in value, and you sell it for a profit. That profit is called a capital gain. Now, there are two types of capital gains, short-term and long-term. Short-term capital gains are for assets you hold for less than a year before selling, and they're taxed at your ordinary income tax rate. So yeah, definitely avoid those unless you just hate money. Long-term capital gains are for assets you hold for over a year. These are taxed at a lower rate, and for most of you, that rate is going to be 15%, which in general is a much better deal, so plan to hold your investments for a while. Other investments, like bonds, pay interest, which is money a lender pays for borrowing money. Interest income is typically taxed as ordinary income, although interest from municipal bonds are tax-free at the federal level and sometimes even at the state and local level. And then there are dividends, which are little bonuses that companies pay out to their shareholders. Now, these can be qualified dividends or non-qualified dividends. Qualified dividends are taxed at the long-term capital gains rate, while non-qualified dividends are taxed as ordinary income. So, how does this affect your investment choices? Well, the higher your tax bracket, the more detrimental taxes are going to be for any type of return that is taxed at your ordinary income tax rate. The more taxes you're paying on investments, the larger the drag will be on your portfolio's overall performance. So the question you need to ask yourself is, do you want less money or more money? And look, we're not going to go through every type of investment and how they're taxed. That's really not the point of this video, but I want to stress that taxes should definitely be a factor in how you choose to invest. However, regardless of your tax bracket, it always makes sense to try and avoid paying taxes. Because if the richest person in the world isn't going to, well, why should you? And the best way to do this is by investing in low-cost passive index funds, such as a fund that tracks the S&P 500 or a total stock market index fund. While you'll never avoid taxes entirely because many stocks within these indexes pay out dividends, they'll be much more tax efficient than if you're in an actively managed fund or trading in and out of stocks yourself and racking up all those capital gains. The bottom line is, taxes can have a huge impact on your investment returns. So do some research, understand your own tax situation, and stop funding tax breaks for corporations to destroy the planet.
Okay. Look. Killing the indigenous looks bad. But there's one thing that shareholders hate more than bad press, and that's a bad quarterly statement.
If you've made it this far, congratulations, because we saved my favorite part for last. When you're in retirement and you need to start selling your investments for income, it's actually possible to get away with paying 0% in capital gains. And I'm not talking about from your retirement accounts. Now, if the thought of avoiding capital gains taxes altogether doesn't rustle your jimmies, then I don't know what to tell you, because that's one of the best deals you're going to get. Okay, but how is that possible?
Through the power of friendship.
Actually, it's just tax law. As it turns out, if your taxable income is under a certain amount, for 2025, it's $48,350 for single filers and $96,700 for married filing jointly, you will pay 0% in long-term capital gains. Now, this will be a bit of a juggling act, but basically, if you're smart about it, you can balance withdrawals between your traditional and Roth retirement accounts, any additional income sources, and cost basis for any taxable stock sales to keep your taxable income under these limits, and thereby avoid paying any capital gains tax. Okay, let's break down how this actually works. Think of your 0% capital gains limit as a bucket. You have different sources of income that can fill that bucket. First, you'll have ordinary income, like Social Security or required minimum distributions, or RMDs, from your traditional IRA that will take up space in your bucket. As you need more income, you can withdraw from your traditional retirement accounts. But here's the key. Don't take out so much that you get bumped into the next tax bracket. Instead, leave some room in your bucket for those capital gains. This is where you can strategically sell some of your investments and pay 0% in taxes on those profits. You can even get fancy and manage the cost basis of your sales to control how much your sale is considered gains versus principal to optimize your transaction based on how much you need. And finally, if you've reached the income limit and you still need more cash, you can tap into your Roth accounts, because remember, those withdrawals are tax-free and don't count towards your taxable income. This means you can potentially have an income that's much higher than the 0% capital gains threshold while still technically staying under the limit and paying 0 taxes on those gains. So, with a little strategic planning, you can create a tax-efficient retirement income stream and keep that creep Uncle Sam from rummaging through your pockets.
Ew! Get off of me! Ugh, as if!
As mentioned, this will take some planning to map out your expenses, your available assets, and how you'll plan to withdraw them. But without having a fundamental understanding of how these tax brackets work and where you fall in them, you can't even get started. This explanation was pretty simplified since this topic is a bit out of scope for this video, but I plan to make a video entirely dedicated to how you can avoid these capital gains taxes, and I'll link it here when it's available. If you have a favorite tax-saving tip, I'd love to hear what it is, and if you have any questions, I'd be happy to answer them in the comments. Remember, folks, if people worth more than entire countries are going to avoid paying taxes, you should too. Be sure to subscribe for more financial tips, and I'll see you in my next video. Venture on.